Seconds, the role of insurance. Insurance spreads the risk of loss from one person to a large number of persons through the pooling of premiums. Insurance is the transfer of risk from one party to another through a legal contract, or the transfer of risk through pooling funds. The policy owner is transferring the chance of a possible financial loss to another party, that is, the insurer. The insurer assumes the risk since it receives a premium. When the transfer of risk is accomplished by purchasing an insurance policy, the policy owner obtains a large quantity of coverage in return for a small fee. That is premium. Benefits and costs of insurance to society. Most contracts of insurance are contracts of indemnity designed to pay off financial losses and reimburse the insured. The premium cost can be reduced when the insured implements loss control measures, for example, smoke alarms or a sprinkler system, to lower the chance of a loss occurring in the first place. Insurers take some of their revenue and invest it back into local and national economies to benefit all society. Private commercial insurance companies. Anything not owned by the federal or state government is typically considered a commercial or private insurance company. A company that only sells one line of insurance, for example only health insurance, is known as a monoline insurer. Companies that sell more than one line of insurance are known as multi-line insurers. Stock companies, non-participating. A stock insurance company is a private organization, organized and incorporated under state laws for the purpose of making a profit for its stockholders, shareholders. It is structured the same as any corporation. Stock dividends are paid to stockholders. Directors and officers are responsible to the stockholders. A stock company is referred to as a non-participating company because policyholders do not participate in dividends. Stock companies look to grow their earned surplus or post-tax earnings not paid in dividends. Earnings retained by a company are considered equity and, as such, are owned by the shareholders. Mutual companies participating. Mutual insurance companies are also organized and incorporated under state laws, but they have no stockholders. The owners are the policyholders. Anyone purchasing insurance from a mutual insurer is both a customer and an owner. Policy owners have the right to vote for members of the board of directors. Mutual companies are referred to as participating companies because the policy owners participate in dividends. By issuing participating policies that pay policy dividends, mutual insurers allow their policy owners to share in any company earnings. Divisible surplus. The divisible surplus is the amount of earnings paid to policy owners as dividends after the insurance company sets aside funds required to cover reserves, operating expenses, and general business purposes. Policy dividends represent a refund of the portion of premium remaining after the company has set aside the necessary reserves and has made deductions for claims and expenses. Surpluses are typically distributed to policy owners on an annual basis. A stock company may be converted into a mutual company through a process called mutualization. Mutual companies can convert to stock companies through a process called demutualization. A stock insurance company issuing both participating and non-participating policies is referred to as using a mixed plan. Participating policies allow policyholders to participate in the company by electing the board of directors and receiving dividends from the divisible surplus. Non-participating policies do not allow policyholders to participate in elections or dividends, and instead aim to increase profit for the shareholders. Strong assessment mutual insurers. Assessment mutual companies are classified by the way in which they charge premiums. A pure assessment mutual company operates on the basis of loss sharing by group members. No premium is payable in advance. Instead, each member is assessed a portion of the losses that actually occur. An advance premium assessment mutual charges a premium at the beginning of the policy period. If the original premiums exceed the operating expenses and losses, the surplus is returned to the policyholders as dividends. If total premiums are not enough to meet losses, additional assessments are levied against the members. Risk retention and risk purchasing groups. RRGs and RPGs are group-owned liability insurers that assume and spread product liability and other forms of insurance risks among its members. This type of group is formed for the primary purpose of retaining or pooling risks. Risk retention groups are licensed in their state of domicile and are owned by their policyholders, who are business owners, who are also the shareholders. A risk retention group or risk purchasing group only has to be licensed in one state, but may insure members in any state. Service providers. Service providers offer benefits to subscribers in return for the payment of a premium. These services are packaged into various plans, and those who purchase the plans are known as subscribers. Examples of service providers are health maintenance organizations, HMO, and preferred provider organizations, PPO. Fraternal benefit societies. Fraternal societies have memberships based on religious, national, or ethnic lines. To be characterized as a fraternal benefit society, the organization must be non-profit, have a lodge system that includes ritualistic work, and maintain a representative form of government with elected officers. Fraternal must be formed for reasons other than obtaining insurance. Today, fraternal benefit societies issue insurance with similar provisions found in insurance policies issued by commercial insurers. Fraternal benefit societies are more concerned about maintaining minimum reserves and surpluses for coverage than providing dividends or profits. Reciprocal insurers. Similar to mutual, reciprocal insurers are organized on the basis of ownership by their policyholders. The policyholders themselves insure the risks of the other policyholders. Each policyholder assumes a share of the risk brought to the company by others. An attorney in fact manages reciprocals. Lloyd's of London. Lloyd's of London is not an insurer but rather a syndicate of individuals and companies that individually underwrite insurance. Lloyd's can be compared to the New York Stock Exchange, which provides the arena and facilities for buying and selling public stock. Lloyd's function is to gather and disseminate underwriting information, help its associates settle claims and disputes, and through its member underwriters, provide coverages that might otherwise be unavailable in certain areas. Reinsurers and retention limits. Reinsurance is an arrangement by which an insurance company transfers a portion of an assumed risk to another insurer. Reinsurance takes place to limit the loss any one insurer would face should a very large claim become payable. It also enables a company to meet particular objectives, such as favorable underwriting or mortality results. The company transferring the risk is called the ceding company. The company assuming the risk is the reinsurer. The portion of the risk that the ceding insurer retains is called the net retention, or net line. Treaty reinsurance involves an automatic sharing of the risks assumed. In a reinsurance agreement, the insurance company that transfers its loss exposure to another insurer is called the primary insurer. Captive insurer. An insurer that is established and owned by a parent firm for the purpose of insuring the parent firm's loss. Surplus lines insurance. Surplus lines insurance refers to the non-traditional insurance market. A person will seek coverage through a surplus lines broker in order to secure coverage for high or unusual risks. That is, hole-in-one insurance or non-appearance coverage. In order to qualify for surplus lines coverage, an effort has to be made to secure coverage in the authorized market. An individual may not attempt to secure coverage just because it may be less expensive. Self-insurers. Rather than transfer risk to an insurance company, a self-insurer establishes a self-funded plan to cover potential losses. Large companies often use self-funded plans for funding pension plans and some health insurance plans. A self-insurer may look to an insurance company to provide insurance above a specified maximum level of loss. The self-insurer will bear the amount of loss below that maximum amount. Private versus government insurance. Private citizens or groups own private commercial insurance companies, offer individual, group, industrial, or blanket insurance policies. Government insurers are owned and operated by a federal or state entity. May either write insurance to cover perils that are not insurable by commercial insurers, that is, war, flood, a nuclear reaction. Write insurance on insurable risks and thus compete with the commercial marketplace. That is, social insurance such as workers' compensation. Government insurers generally write insurance to cover catastrophic perils, that is, flood, or to protect a segment of society, that is the elderly, against catastrophic medical costs, that is Medicare. Examples of government insurance programs include National Flood Insurance Program and Federal Crop Insurance Corporation, Social Security, Medicare and Medicaid, Servicemen's Group Life Insurance, SGI, and Veterans Group Life Insurance, VGI. Insurer classification according to domicile. A domestic insurer has its principal or home office in a state where it is authorized, is chartered in or formed under the laws of the state where it is authorized. Nationwide Insurance Company of Columbus, Ohio, operates as a domestic insurer in the state of Ohio. A foreign insurer is authorized in one state, but its charter or principal office is in another state. Nationwide Insurance Company is also licensed or authorized in the state of Illinois as a foreign insurer. Alien insurers are insurers authorized in any state within the U.S., whose principal office is located outside this country. Nippon Life of Tokyo, Japan, or Sun Financial Services of Toronto, Canada, are examples of alien insurers. Insurer classification according to authorization. An insurer that is allowed or authorized to conduct insurance business in a particular state is referred to as an authorized or admitted insurer. Authorized admitted insurers are issued a certificate of authority. An unauthorized insurer, non-admitted company, is not permitted nor allowed to conduct insurance operations in a particular state. Unauthorized, non-admitted insurers do not have a certificate of authority. In some states, unadmitted insurers may still offer surplus lines insurance without a certificate of authority if no authorized insurer in the market is available or willing to take the risk. Departments within an insurance company. The marketing or sales divisions are responsible for increasing the number of prospective applicants, thereby increasing the number of insureds. Through various advertising mediums and one-on-one appointments with prospective buyers. The sales department is typically the department completing the application. They may also be known as field underwriters. The underwriting department is responsible for reviewing applications, conducting investigations to gain additional information about applicants, assigning risk classifications, and approving or declining an application. The claims department is responsible for processing, investigating, and paying claims for losses incurred by insureds. The actuarial department calculates policy rates, reserves, and dividends, and makes other applicable statistical studies and reports focusing on morbidity and mortality tables. How insurance is sold. Most consumers purchase insurance through licensed producers who present insurers' products and services to the public via active sales and marketing methods. Producer agents represent a particular company. A captive or career agent works for one insurance company and sells only that company's insurance policies. Producer brokers are not tied to any particular company and can represent many insurers' products. An independent agent works for himself and sells the insurance products of many companies. May represent as many insurers as will appoint him. In a sales transaction, agents represent the insurer and brokers represent the buyer. Career agency system. Career agencies are branches of major stock and mutual insurance companies that are contracted to represent an insurer in a specific area. Career agencies recruit, train, and supervise agents through managers or general agents. They primarily build staff. An insurer uses the managerial system when they hire a salaried branch manager to run the agency instead of a general agent. The branch manager supervises agents working out of that branch office. The insurer pays the branch manager's salary and pays him a bonus based on the amount and type of insurance sold and the number of new agents hired. Personal Producing General Agency System. Personal Producing General Agencies, PPGA, do not recruit, train, or supervise agents. They primarily sell insurance. Agents hired by a PPGA are considered employees of the PPGA, not the insurance company, and are supervised by regional directors. Independent Agency System. Independent agents American agency system represent any number of insurance companies through contractual agreements. They are compensated on a commission or fee basis for the business they produce. Other methods of selling insurance. An insurer using direct selling and mass marketing methods deals directly with consumers by selling its policies through vending machines, advertisements, or salaried sales representatives. No agent or broker is involved. Also includes internet, newspaper, magazine, radio, and television ads. Provide exposure to large groups of consumers, often using direct selling methods with occasional follow-up by agents. Evolution of industry oversight. The primary purpose of this regulation is to promote the public welfare by maintaining insurance company solvency. Other purposes are to provide consumer protection and ensure fair trade practices and fair contracts at fair prices. 1868, Paul v. Virginia. Decided by the U.S. Supreme Court, involved one state's attempt to regulate an insurance company domiciled in another state. The Supreme Court sided against the insurance company, ruling that the sale and issuance of insurance is not interstate commerce, thus upholding states' right to regulate insurance. 1933. The Glass-Steagall Act, Banking Act of 1933, separated commercial and investment banking by barring common ownership of banks, insurance companies, and securities firms. Erected a regulatory wall between banks and non-financial companies. 1944 United States v. Southeastern Underwriters Association, SEUA, decided by the Supreme Court again. In the SEUA case, the Supreme Court ruled that the insurance industry is a form of interstate commerce. As such, the industry is subject to a series of federal laws, many of which conflicted with existing state laws. It did not affect states' power to regulate insurance, but it did nullify state laws that conflicted with federal legislation. The decision shifted the balance of regulatory control to the federal government. The McCarran-Ferguson Act. Enacted by Congress, Public Law 15. This law made it clear that the state's continued regulation of insurance was in the public's best interest. It also made possible the application of federal antitrust laws to the extent that the insurance business is not regulated by state law. Led each state to revise its insurance laws to conform to the federal laws. Today, the insurance industry is considered to be state-regulated. A violation of the McCarran-Ferguson Act may result in a fine of $10,000 or up to 1 year in jail. 1958 intervention by the FTC decided by the Supreme Court. Federal Trade Commission, FTC, sought to control the advertising and sales literature used by the health insurance industry. The Supreme Court held that the McCarran-Ferguson Act disallowed such supervision by the FTC, a federal agency. 1959 intervention by the SEC decided by the Supreme Court. The Supreme Court ruled that federal securities laws applied to insurers that issued variable annuities and thus required these insurers to conform to both SEC and. The SEC also regulates variable life insurance. The National Conference of Insurance Legislators, NCOILS. The organization formed to help legislators make informed decisions on insurance issues that affect their constituents and declare opposition to federal encroachment of state authority to oversee the business of insurance. As authorized under the McCarran-Ferguson Act of 1945. 1970s Fair Credit Reporting Act, enacted by the federal government, attempt to protect an individual's right to privacy. The authority requires fair and accurate reporting of information about consumers, including applications for insurance. Insurers must inform applicants about any investigations that are being made upon completion of the application. If any consumer report is used to deny coverage or charge higher rates, the insurer must furnish to the applicant the name of the reporting agency conducting the investigation. Any insurance company that fails to comply with this act is liable to the consumer for actual and punitive damages. The maximum penalty for obtaining consumer information reports under false pretenses is $5,000 and 1 year imprisonment. 1999 Social Services Modernization Act, enacted by Congress, repealed the Glass-Steagall Act of 1933. Commercial banks, investment banks, retail brokerages, and insurance companies can now enter each other's lines of business. 2001 USA Patriot Act, uniting and strengthening America by providing appropriate tools required to intercept and obstruct terrorism Act, is designed to detect and deter terrorists and their funding by imposing anti-money laundering requirements on brokerage firms and financial institutions. 2003 National Do Not Call Registry. Insurance calls are not exempt from the No Not Call Registry. National Association of Insurance Commissioners. All state insurance commissioners, directors, or superintendents are members of the National Association of Insurance Commissioners, NAIC. Establishes committees that regularly examine various aspects of the insurance industry and recommend applicable insurance laws and regulations. The NAIC has 4 broad objectives: to encourage uniformity among state insurance laws and regulations, to assist in the administration of those laws and regulations by promoting efficiency, to protect the interests of policy owners and consumers, to preserve state regulation of the insurance business. NAIFA, National Association of Insurance and Financial Advisors. NAHU, National Association of Health Underwriters. Members of these organizations are life and health agents dedicated to supporting the industry and advancing the quality of service provided by insurance professionals. These organizations created a code of ethics detailing the expectations of agents and their duties toward clients. Unfair Trade Practices Act. Most jurisdictions have adopted the NAIC's Unfair Trade Practices Act, gives the head of each state insurance department power to issue a cease and desist order, investigate insurance companies and producers, and impose penalties for violations. Gives officers the authority to seek a court injunction to restrain insurers from using any methods believed to be unfair. Included in the context of unfair trade practices: misrepresentation, false advertising, coercion, intimidation, unfair discrimination, inequitable administration of claims settlements. Advertising code specifies certain words and phrases that are considered misleading and cannot be used in advertising of any kind. Requires full disclosure of policy renewal, cancellation, and termination provisions. Agent marketing and sales practices. Every state requires its licensed producers to adhere to specific standards designed to protect consumers and promote suitable sales and application of insurance products. Selling to needs. The ethical agent determines the client's needs and then determines which is best suited to address those needs. 2 principles of needs-based selling include finding the facts and educate the client. Suitability of recommended products. The ethical agent assesses the correlation between a recommended product and the client's needs and capabilities by asking and answering the following questions. What are the client's needs? What products can help meet those needs? Does the client have the capability, financially and otherwise, to manage the product? Is this product in the client's best interest? Full and accurate disclosure. The ethical agent makes it a practice to inform clients about all aspects of the products recommended, including benefits and limitations. There should never be an attempt to hide or disguise the product's nature or purpose or the company being represented. Insurance products should be presented clearly, completely, and accurately. Documentation. The ethical agent will document each client's meeting and transaction. The agent uses fact-finding forms and obtains the client's written agreement for the needs determined, the products recommended, and the decisions made. Ethical agents know the state laws regarding documentation and follow them precisely. Client service. The ethical agent knows that a sale marks the beginning of a client relationship. Routine follow-up calls are recommended to ensure that the client's needs always are covered and the products in place still are suitable. When clients contact their agents for service or information, these requests are given top priority. Complaints are handled promptly and thoroughly. Producer responsibilities. The producer is the conduit between the company and the insurance buying public and must make sure that at all times their actions are compliant with all current insurance regulations. To help all insurance company customers with the best service possible. Solicit new business for the company by assisting clients in the process of acquiring products from application to policy delivery. Knowledgeable about all company products and services. Guide customers to the right products to meet their actual needs and maintain such a relationship regularly. Build a more substantial business for the company by keeping current customers satisfied and actively seeking referrals for new business. Diligently assist in the claims process, keep customers apprised of continuing developments with any claims, and help assure a prompt and equitable claims experience. The producer must be acutely aware of company underwriting guidelines to minimize wasting the underwriter's valuable time and skills on poorly matched products and customers, and to assist the underwriter in any way to facilitate the application process. Buyer's Guide. Each state requires agents to deliver a buyer's guide to consumers that explain various types of life insurance products and other information on the recommended policy, such as premiums, dividends, and benefit amounts. Policy Summary. Help consumers evaluate the suitability of the recommended product. Guarantee associations are established by all states to support insurers and protect consumers in the event an insurer becomes insolvent. State life and health guarantee associations provide a safety net for all member life, health, and annuities insurers in a particular state. Guarantee associations protect insureds in the event of insurer insolvency or inability to pay claims up to a specific limit. Rating services. The primary purpose of a rating service company such as AM Best, Fitch Ratings, Standard & Poor's, and Moody's is to determine a company's financial strength and publish the rating. An insurer's financial strength can usually be evaluated by looking at the company's reserves and liquidity. Reserves. They are the accounting measurement of an insurer's future obligations to its policyholders. They are classified as liabilities on the insurance company's accounting statements. Liquidity indicates a company's ability to make unpredictable payouts to policy owners.